Right, so we're going to spend the next little while hearing some of the thoughts from the guys up here. I think specifically on markets yesterday, last year. Yesterday was fine. Last year, and how it was to be a PM in that space. But I think more specifically on what the future holds and hopefully some of the high conviction ideas they're looking at the moment. Just to quickly run through introductions. On the far end there we have Matthew Thompson. Matthew started his investment career at a boutique long-only manager before seeing the light coming over to Peregrine Capital in 2018. And then Dave Fraser, who I'm sure most of you know, is the founder of our business and currently executive chairman. So, as Jacques mentioned, we would love this to be as interactive as possible. So please feel free to ask questions throughout the session. There will be a couple of roving mics. So please, if you've got a question, stick your hand up. Someone will bring you a mic. I will ask you, please just speak into the mic so everyone can hear what you're having to say. But I'll kick off with a couple of questions while you guys are formulating yours. And given that we're starting with a chat about what happened in 22, it seems like a long time ago, but we did go through some quite significant challenges last year. So I thought I'd just very quickly summarize what the year had to offer. So, as Jacques mentioned, Russia started the year invading Ukraine. That created a food and energy crisis that led the developed world to print inflation numbers that we haven't seen in the last 40 years. That interest rate hike was pretty brutal by anyone's suggestion, and I think that obviously was felt quite painfully in equity markets around the world. That was followed by a nice pop in a number of bubbles, particularly in the non-profit tech space, cryptocurrencies, NFTs, and the like. China had their own stuff to deal with. The economy kind of hit the skids around housing markets concerns and their zero COVID policy. And then obviously back in our sunny tip of Africa, we were dealing with floods, load shedding, and a general lack of service delivery and crumbling infrastructure. So it certainly wasn't an easy year, but I get the feeling it was a very interesting year to be a portfolio manager. So guys, maybe we can kick off, Jacques, with you, just to give your thoughts on what it was like managing a fund in that environment.
Yeah, Alan, I think the interesting thing about that list of yours is that very few of those would have been predictable at the start of the year. I think had one done the work on inflation rates, one could have seen that was a risk. But several of these other events, how China would continue to lock down their economy under COVID, I think that obviously the war again, these were just not predictable events. So I think it was a tough year, and I don't want to make anything about that it was tough. It was a pretty exciting year as a portfolio manager. You had lots of problems to solve, you had lots of things thrown at you, and I think it was a great stress test for our team to be debating these things. And I think more than most years, last year we had lots of intense sessions in our boardroom where we kind of put different views on the table and we try to think through them and figure out which one is more likely to apply. So I think it was certainly an enjoyable year overall for me. I'll maybe hand it over to Dave or Matt if they want to discuss through a few of the specific opportunities or things we did.
Yeah, I think I've sort of long resigned myself to having a nice quiet year. I think maybe in my first few years in markets we had a nice sort of trending bull market, but I think these days the sort of unusual or unpredictable is unfortunately part of our lives at the moment. And I think when we look forward now, I guess in South Africa we're dealing with a significant load shedding situation, which I think companies need to sort of resign themselves that this is not something that is going to be solved over the next sort of 12 to 15 months, or will be resolved over that sort of period, but in the short term need to readjust again. And again, we talk about South African companies and management teams being resilient, and I think that's probably an overused word now, but I think they're tired of being resilient, but they're going to have to be resilient again and deal with this power crisis that we've got at the moment, because certainly for the next 12, 15 months, we're not going to have baseline power. I think, stage 4 to 6, unfortunately, is going to be the new normal. But again, it's up to our quality companies and quality management teams that we back to get out there and solve this issue the best they can. Shoprite put out the other day that it's cost them another 500 million, R500 million in the first 6 months just in diesel, extra diesel. So these are very significant numbers for South Africa, and I think our companies have got to show their mettle again and get out there and manage the situation. So again, that's the most recent one to hit us, and I think that'll be around for certainly the next 12 to 18 months.
I think it was quite interesting because it felt like every 2 weeks there was something that hit us that we had to, get into the office early or chat over a weekend and get on a Teams call. But, we were ready in December to go on a break, and then this Pala scandal happened, and Ramaphosa was about to leave, and it felt like we were on the cliff edge again. But thank goodness that was sorted, and it felt like all of us had a good break in 2022 in December and started again with a fresh pair of eyes. Just from my side, coming from a boutique long only, as Alan mentioned, just the ability in a year like 2022 to manage a hedge fund compared to a long-only fund was absolutely key, and that's what gave us the ability, is using the full range of tools that we have in our arsenal to use, and we pretty much used all of them in 2022 on all the different crises, and that enabled us to give a very smooth and very strong ride for investors. So I think we can be very pleased with our 2022 performance, but in saying that, we also came back on the 1st of January and we said, right, we still have to perform this year, and the uncertainties remain pretty much the same as 2022. It still looks very uncertain out there with the risks that Jacques mentioned in his presentation. So we can't rest on those laurels of strong performance in 2022, and I think it's been a good start for us. But yeah.
Cool. Matt, maybe on that Pala comment, I think it's something is worth noting is when we see events like that happen, and we're on that day, I think it was touch and go where the Cyril went, it was a bit like COVID, where we saw it early in the morning. I think one of the papers thought it was published on Twitter. We got together as a team, and actually what we did in that first hour of trading, we put on a massive rand-dollar 1 month call option, like protecting basically half the fund with a rand-dollar call. So you're not going to see that in the returns, because in the end he stayed. But in the scenario where he did leave and the rand was going to gap higher, I think the fund would have actually been a net winner of that, where I think the SA markets would have been very weak. So, stuff like that you won't always see, but it's again like our COVID, like the COVID situation, we're willing to take action, spend a little bit of premium, and make sure we take the tails out for investors, that if one of these major events happen, we can move fast enough, our size is still small enough, where you can actually protect the whole fund within an hour, take rapid action, and at fairly low cost if you structure the transaction right.
Yeah, I think that ability to be nimble was incredibly important last year, and that list of things that I read out earlier, not a lot of those have been solved for. I think those things continue. So maybe Matt, you can just talk us through kind of our thinking. Jacques obviously touched on some of it in the presentation, but what is it that we're looking at as drivers of potential market returns this year from a macro perspective, and maybe specifically talking global numbers, and I'll get Dave to talk more local stuff in a minute, but what are the thoughts, like what are we looking for, what are the flags?
Yeah, so I think when we talk globally, everyone is still somewhat worried about inflation. It is decelerating, and I think the whole market's in agreement that inflation is coming down. The key is to what level it gets down to, and that has an impact on Fed rates and the ultimate Fed rate, which at the moment, 4.5% in US dollars. If you said that to anyone in the room 2 years ago, they would have laughed at you. So when we construct the portfolio, we really have to think you can get 4.5% in dollars with zero risk. That is the starting point. Our opportunities that we have in that equity bucket, where we're running about 55% net equity exposure, are fantastic equity opportunities that we think can materially outperform that cash benchmark and provide a reasonable level of risk. So globally, we've put on some put protection, as Jacques mentioned, specifically on the S&P. It's been a very strong run into the beginning of the year, and we have sold down on some of our positions as well. But in saying that, if markets do continue running, we won't be completely left behind, because some of our bonds, some of our equity positions will still run with the market. But I think in general, we're well positioned, fairly cautious, and if there's a pullback, you can be rest assured that we will take those opportunities if they arise.
Yeah, I think on the South African side, we've focused very strongly on companies that have the ability to pass through the power issues and the increased costs that they're going to incur in that. So again, it's about picking the right businesses that have pricing power, that have the ability to push through price increases and recover their margins in this very tough time, particularly with the power crisis right now. So again, it's quality of business, and again, we'd rather we'd rather back the quality managers that we have in South Africa who manage these businesses. So I think that's really what, it's not our job to tell them where to put the powers, the generators. They're clever enough to know that, and we back the right people. They will come out of this stronger. And I think what we're seeing now is that bigger companies or companies that have the ability to react to this will come through this crisis stronger. We're seeing almost without exception, every single mining company is now embarking on solar projects. This was already in the pipeline over the last year or so, but certainly the acceleration of that is going to happen. And I think every company in South Africa has realized that Eskom is just not a reliable base load producer of electricity over the medium term. So I think we're going to see some investment into solar. Hopefully when Eskom eventually does put its act together and comes back, we actually almost don't need it like we used to. So again, South Africa is our hunting ground. It's where we spend most of our time. It's where we live. It's where we have the biggest history and track record of analyzing companies. And certainly we are finding quite a few nice, exciting South African opportunities right now. And again, it doesn't mean to say that we're particularly excited about South Africa, but there are some certain companies. And again, our ability to do, for example, pair trades, where we buy one company in a sector and short another one, because I think the better companies are going to show their mettle right now, and that gap between the lesser companies or companies with poorer management is going to open up again.
We've got a central list of, let's say, the 200 or so companies we cover in detail, where we can rank order everything by expected return over the next 2 years. And there's times when everything on that list is green. So let's say during the COVID sell-off in 2020, like everything looked cheaper, so you can almost just buy a basket of tech names or global shares, and we thought everything was going to deliver attractive returns. And then during times of 2021, when the SA economy had recovered, but a lot of the shares were still cheap, there was times when, for example, the bank sector was showing 30% IRRs, several sectors were showing very, very high returns again, so you could basically buy a basket of them. Right now, with both how markets have recovered and with how our view of company earnings have come down, there's not that many things on this list that's showing 30 or 25% plus. So right now, we're building our portfolio with the specific companies with 30, 40% IRRs, but that's often because it's a specific opportunity. There's even a few activist opportunities. There's a few takeout opportunities we're busy with. So right now, we're almost focused on stock-specific good ideas. I mean, there's still a few good overall market ideas in the fund, but I think it's a time to look for alpha, not just in the overall market, but in specific ideas, and that's why our net equity exposure is also somewhat lower right now.
I mean, just maybe on the fixed income side, because as you mentioned, it's quite elevated at the moment. Matt, maybe take us through some of those specific opportunities. I think because we need to make it clear that we're not a house that simply allocates to fixed income as portion of a bucket. I mean, if you look through the performance of the funds over time, there are periods, years, where we have almost no fixed income exposure, and often ours is in kind of the corporate credit space. So maybe talk through some of those opportunities at the moment.
Yeah, I mean, I think in 2021 we had zero fixed income exposure. It made no sense because you weren't earning the right return for the risk that you were taking. But one of the hunting grounds that we found to be fantastic, and we've almost had a 100% hit rate in this up until now, is South African companies that have offshore listed bonds. So one of the attractive opportunities that we found in the middle of last year was an ABSA bond, 2028, trading at double-digit USD yields. So we locked in 12% in dollars for our investors purely because everything in the world is looking volatile, and if you're a guy sitting in New York and you don't know what to do, you see these bonds called ABSA, you don't know what ABSA is, you just sell them. So we chat to the brokers, we understand who the sellers are, we understand why they're trading at the levels that they're trading, and to lock in that kind of yield for our investors with extremely low risk. I mean, Jacques covered ABSA for how long? He knows the story, he knows the capital structure, it's extremely well capitalized. So we like those kinds of opportunities that are not just, okay, it's a good time in the market to own fixed income because we think yields will come down. It's more very specific, a basket of fixed income opportunities that allow the portfolio to do the work. And I think at the moment our running yield is somewhere between 10 and 11%, potentially higher from the capital returns once those bond yields come down as investors start buying them again.
And I mean, it's probably 2 or 3 opportunities like that. And what we also do is we hedge that back to rand. I mean, we want to deliver rand returns for investors, so we take that 11 or 12, we hedge it back to rand, we lock in, I think 15 to 18% was the rate we locked in on these bonds. So if you have to hold them to maturity, you're going to make that. And we don't think any of these companies are going to go bust. We just don't think there's any chance of ABSA going under, for example. So you're locking in 15 to 18, and as Matt said, it could be upfronted by capital return. If they trade all the way back to R, we will take the fantastic RR, sell it back to cash, and wait for the next opportunity if that arises.
So I mean, maybe turning our focus a little bit to US inflation specifically. I mean, we know that South African management teams, or good South African management teams, inflation is something that they're used to. It's something that they have dealt with for a very long time. This certainly isn't the case in a lot of the developed market. I mean, most of these guys probably have never seen inflation numbers like these in their tenure. Are you seeing any particular opportunities of beneficiaries to higher inflation in global markets?
So, Alan, it is a specific strategy we had as a team to say, let's have specific meetings where we say, let's see if we can find companies that will be net beneficiaries or will be less impacted by inflation. I think our single best idea there is just owning Visa and MasterCard, the global payments operators. Effectively, what they do is they take a very small tax, 0.1% or so of global nominal retail spend. And the beauty there is the moment that anyone puts through a price increase anywhere in the world, the next credit card swipe, Visa or MasterCard has that. So they never have to take pricing themselves. Millions of individual businesses will take the pricing for them. So we think those businesses just provide a great inflation hedge, both in the top line, and then their margins are high. They're like 60, 70% profit margin businesses. And then even your cost base is somewhat more fixed because it's system spend that's already been invested. So we think they provide fantastic inflation hedges. They've worked very nicely year to date and towards the back end of last year. And I think in the scenario where inflation doesn't come down so easily, we think the market will look for businesses that say, in a 3 or 5 year cycle of high inflation, which companies can, on a very low risk basis, capture inflation. And we think companies like Visa, MasterCard will probably get bid up even further. So you'll capture both inflation and potentially some re-rating. So you'll capture strong earnings growth and a re-rating on the PE multiple, which is, I mean, we've sold a little bit, but we've still got nice core holdings in those.
Cool. Are there any questions from the floor at this point? Otherwise, I do have some backups just in case, but...
Here we go.
We just hang on for the mic. Sorry, my marketing team were very specific. They got to talk into that.
Hi, you haven't mentioned potential grey listing, and I'm just wondering what your thoughts are around that, and probably specifically around the impact on SA bonds. Thanks.
Thank you.
So the questions on the grey listing risk. So I've spoken to most of the large banks on this that I think is probably in the best seat to both have a view on it and to have some view on the impact of it. I think in their eyes, it's a fairly 50-50 story right now. I mean, we have taken some action after it became clear that we were at risk of this grey listing. So I think there is still a reasonable chance of us potentially avoiding this. But in speaking to them, none of them could come up with like immediate short-term risk. It's kind of a negative check against you, but if you think back on when South Africa got downgraded to below investment grade, I think there was big fears at the time that this would be a big event. I think in the end what happened is a few funds sold our bonds, maybe our bond yields moved up a little bit, but it was kind of left there. And if you talk to them, they think it's probably that kind of impact, but of lower magnitude. So it's certainly not an ideal scenario, but I think it's an easier scenario to come out of than a downgrade. So if you get your compliance up, you'll come out of it in a year or two. And there's very few funds specifically with mandates linked to this grey listing that would be for sellers. So if anything, there could be an impact, but probably marginal was their view. So, and I guess that's the view we've taken so far is let's trust the banks that's had teams on this and seem somewhat worried, but not too stressed on it.
Would you just stand up, Sunshine? Firstly, congrats on your returns of last year and more importantly of the last 25 years. I'm kind of interested to get a sense of what the succession plan is of the business, what you see as the end game. And there have been some changes to making your funds available to platforms and the like. Has that had an impact on the process, and do you see any changes in that respect?
Now, I'll speak to succession planning, and I think we've got a great pipeline of people, and bear in mind, unlike other hedge fund businesses, this is not an autocracy where, the most senior guy makes decisions. I mean, we've always had a federal model. We sit down all together, we try and make a collective decision. The people who are best placed to make the decision make decisions about investment sizing and investment, actually actioning on investments. So I think it's important that we continue to have a team like we've got, of 5 or 6 or 7 very capable and experienced people to discuss decisions and make them. So in our business, succession planning isn't about one key individual leaving or one key individual moving. We have a philosophy and a framework that we've had for literally since we started 25 years ago. And as long as we stay true to that framework, the business continues as it does. And we have had senior churn at senior level over those 25 years. It certainly hasn't been a totally static situation. But as long as those core principles and the way we manage the fund and the way we select investments stay in place, I think this business can do certainly another 25, if not another 50 years. And, I look forward to seeing that.
And I mean, I'll just add to that, Wayne, is I think overall, if you look through the business, we've still got a fairly young team. I mean, I'm turning 40 this year, so I've got a long time that I want to run money. As I said earlier, it's what I love. If I didn't do this, I would just be managing my own money. So why not have it in the fund and manage it with investor money? So I'm certainly hoping that I'll be here for a fair chunk of the next 25 years. I don't want to put David on the spot, but I'm hoping Dave is here for quite a while as well. So I think we're in I think we think about this, but to Dave's point, having that model where there's no one person that makes calls all the shots, as you often see with some boutique managers. So I think it shows we have transitioned over time and empowered more people in the business. So I think this is a lower risk in our business than you'll almost see in most asset managers, I think.
And it's a very unusual model. I think most hedge funds are very specific. There's one key guy who is making the decisions, supported by other people. We've never had that model, nor never will have it.
Platform.
What about the platforms?
Yeah, so look, I think it probably, Wayne, took some of our time initially when, let's say 3, 4, 5 years ago, we had fewer staff, we had an investment team and a few people in the back office. So it took some of my time, David's time, to effectively find Alan or some people in the distribution team, but then that's become Alan's job. So now Alan does the platforms and everything. So look, obviously we speak at these events, but I think that's good in any way to hear what your investors' questions are, think to them. So that's certainly time we think is well worth investing to also stay close to your investors. But other than that, I've got a fairly low admin life where I can focus on investment returns. And as I touched on, we're very clear that performance is all that matters here. Like, we can't have me or Dave or the other guys spending our time on other stuff. We got to have a business where we've got people that we trust that can just handle the other business aspects, and we want to handle managing the funds and picking ideas. I think that the other question that might have been implied in there is thinking about size, and you can trust that we do want to stay small and flexible. It's a lot of our personal money that's in the funds. We don't want to be asset gatherers that runs large portfolios that just do the same as the market. Doesn't excite me. It's not what I want to do with my life. If we ever become that, that's when I'm going to leave. We want to be a business that can generate excess returns, and for that you need to be at a size where you're flexible. So if the size becomes an issue, we'll deal with that. And we've got plans if that's the case. We don't see or feel that right now, but it's something you can trust that we'll watch. And I don't know if many other businesses in SA have the track record where we have been closed on 2 or 3 occasions in the time running the fund.
Wayne, you've known our business for many, many years. I think for me personally, it's fantastic to come to an event like this. We haven't had many over 25 years, and actually just meet the people behind the money. At the end of the day, we manage wealth for people. We don't manage rands and cents, and it's great to kind of maybe sometimes just reconnect a little bit that you're dealing with people's hard-earned money and potential retirement funds and savings. And I think just for everyone to just re-feel that it's a real responsibility and there are real people behind those sort of numbers that we manage on a daily basis, I think that's been certainly for me, a great part of events like this that we've never done before, really, over our 25 years.
I mean, also, if I can add a final point there, Wayne, is to say, I think we've demonstrated that we are a specialist hedge fund management business. So, I mean, we've often had institutional clients approach us, asking us to run long-only mandates for them, and without exception, we have turned those down. And I think the reason we've turned those down is very simply to say, as soon as you add that AUM, you dilute the quality of the idea that goes into these products. And I think, I mean, as Jacques alludes to, it's not purely an altruistic view. The majority of their net worth sits in these funds. They want these funds to do as well as is humanly possible, and we believe that hedge is the best vehicle to achieve that for us. And then just on the LISP side of things, I mean, I think we've done a lot of work to get that access, and the reason we've done that is a lot of guys like yourselves, other advisors in the market have come to us and said, listen, we like your product, we want to use your product, but this platform provides essentially the back office service to my business. And you asking me to come directly through your Manco with your delightful paperwork and FICA and whatever else, it doesn't really help my system. And the single number statement that we were sending out, we were getting a little bit of pushback on that. And so we have done that work, but I can tell you right now, I mean, first of all, less than 20% of the financial advisory community has the license to sell this product. So it is a very niche, very tiny space that we are playing in. So, I mean, while we're trying to open that access for you guys, I think it's purely just for ease of business for the people that support us. It's definitely not an intention to say we're looking to be a 30, 40 billion rand business.
Sorry, hi guys. Congrats on navigating a very tricky period over the last 12 months and coming through the other side so well. Well done. But just looking to the future, if you look at sort of the buzzword or the buzzwords of the last couple of months, you get AI and ChatGPT. I mean, just your thoughts on, is this a game changer? And if so, how does it affect what you guys are doing? And I know it's early days yet, but just any thoughts on how you see that playing out?
So thanks, Ian. Look, it's an area I've personally enjoyed and been sending the guys stuff on a daily basis for the last 2 or 3 months since this product was released. I think it's a very, very interesting innovation. Personally, I think it's by far the biggest thing that's happened in the world in probably the last 10 years. And I think there are scenarios where we look back in 30 or 50 years and say this was the biggest event of the 21st century. If this is the first step towards a generalized AI that happens in the next 50 or 100 years, it could be almost a seminal event potentially in human history even. Now again, it's too early to make that call. I'm just saying that there's some scenarios where that might be the case. I think where it's now, I think it's more almost a glimpse into the potential that sits in this technology over time. Because right now it still makes many mistakes, there's many inaccuracies. I think it's a great tool right now as a type of executive assistant where if you're dealing with any problem, like what I've been doing is you just have this open, if there's any interesting thing that you're dealing with in the business, you just pop it in there and ask for some ideas to help solve it. So I don't know how many other people have played around, but I've certainly used it for that. So I think it's really valuable, and I think that the one obvious area that's at risk would be something like Google's search business. Like if you're looking for a product, I think Google's still better to say if I want running shoes or tennis racket or something, Google's better. But if you say, how do I solve this problem? I think this is a real competitor for search. Now it's slower, it's not always available right now, it's still making mistakes, but I think it's showing you that there is a better solution there. And I think it'll be amazing for productivity in companies around the world. So what I can easily see here is things like call centers. You probably will be able to, 70 or 80% of call center queries will be able to be handled by this. You'll take the general model, you'll train it on the historic scripts of your call center, and that thing's going to do a better job answering it than most call center agents can, and you'll have a few high-end call center agents helping you there. So we're thinking of those kind of opportunities to say, are there maybe businesses? And one of the things I looked at was there's call center businesses in the US listed that runs call centers for large companies. These companies are going to struggle. They're going to lose a lot of business over time. So is there individual longs or shorts? Generally, I think it increases productivity in companies. But I think right now it's an early version. So I think there's going to be time before we're going to have time to see exactly how it impacts things over the next year or two. So I wouldn't say we've taken specific portfolio action on this. It's more, I think it's an extremely interesting global innovation that we're pretty much staying on top of by daily use and doing a lot of research on it. There's a chance that in time it can become a useful tool for our and other fund management businesses. I have actually asked to write pitches for certain stocks and see how it does, and it actually does surprisingly well. But though with mistakes and obviously not being able to analyze the information, but I think it's a glimpse in the power there. So the moment we can, we'll obviously certainly harness this to use it in our business.
I mean, what Alan didn't tell you is all his questions came from the AI ChatGPT. But I mean, just from a stock-specific perspective, something like a Microsoft, which, yes, happens to own some of this open AI ChatGPT, they have one of the biggest cloud services in Azure. You can be rest assured that the amount of data that is going to be processed over the next 20 years is going to exponentially increase. So having the services of one of the big three cloud providers makes us quite confident in a business like Microsoft, which happens to be one of our US holdings that we quite like at the moment. So that's a small way that you can benefit from something like AI in the funds.
Anyone else? Right, so I've got a question that was sent in before this, just asking, I think more, there are a number of fund managers who will have a statement, something along the lines of, we invest in great businesses, or we're looking for great companies, quality. There's obviously the growth value dichotomy that one can get into, but I think often I get asked, what is it that we look at in terms of a business that we were looking to invest in? And I think it's always an interesting thing to differentiate between what is a great business and what is a great investment idea. And maybe you can just give us a bit more insight into what qualifies in that bucket. I mean, you touched on valuation in the slide, but maybe a bit deeper in terms of what you look for in that great investment idea.
Yeah, I think that's a great question, and I almost think that there's two levels to this. Like the first is first level thinking, and that's most people when they start investing, and let's say me back in the day in university, you think buying a share or buying a stock, you think your job is picking a great company. That's the initial thing that you think, like, I should just buy great companies. And that's in our view first level thinking. Second level thinking is making great investments. And in some cases, making great investments is just buying great companies. So when the whole market collapses, for example, and there's massive risk around, when everything's cheap, you can actually just buy a portfolio of great companies. They'll do well even if things fall further, and they'll recover with the market on the way up. But it's actually much more important to differentiate between great investments and great companies. And if I look at our track record, we've certainly had some just great companies that were also great investments. Capitec's probably the best example of that, where we owned that for many years and did spectacularly well. But then if I think about two of our other great investments, was buying African Bank bonds when African Bank was literally bankrupt. So this is the definition of a non-great company that actually goes bankrupt. It was one of our greatest trades ever, buying those bonds at 60 or 70 cents in the dollar. In the end, we got all the interest, we got all the coupons, and I think literally 3 months ago, they paid us our final money that fully made those initial bonds whole. So that was actually a 7-8 year story that came to an end in November last year with a final bit of it. And then Alexander Forbes in a private equity deal, I think on that one we made 5 or 6 times money, and the company didn't grow its earnings in the entire 5 or 6 years that we owned it. So again, it was a reasonable average business, and we could make 5 times our money. So it shows you, in some cases they correlate, but it doesn't always mean you've got to buy only the greatest companies to make great investments.
And Jacques, the one you left out there is Steinhoff. At the end of the day, when Steinhoff went, they had a locally listed preference share. And if you analyze the structure and you went back on the listing document, you realize that the preference share was issued in the South African holding company and not the top company where all the debt was. And again, you realize that the whole Pepcore stable was underneath that and underpinned that value of that preference share. So again, while everybody was running away from Steinhoff, we were busy buying up the preference shares at 20 or 30 cents in the rand. That currently trades at around 80, 82 at the moment. And again, it's a situation now where specifically from someone else's disaster, we found an opportunity, did our work very quickly. Again, it took literally a few hours to get our understanding of exactly who had issued that bond and what level. And again, that's a story of a very poor company where we could make money. So, I mean, it's about making a return, and it doesn't always have to be a great company. It just has to be a great opportunity.
But yeah, in some cases we do own great companies. I think the Visa, MasterCard, I touched on earlier, those are just some of the best businesses in the world. Like a 70% profit margin, you're pretty much a monopoly that probably should be regulated at that stage. So that just shows you how great those companies are. So we do have some of those, and we own them when the valuation makes sense. But you can't just say great company and stop the investment process there. You've always got to take it to valuation as well.
Cool. And maybe just expand on, you find these high conviction ideas, you look for these opportunities, whether they're great businesses or just really mispriced assets, and then how do you build that into a portfolio that achieves the outcomes you're looking for specifically within that mandate?
So, I think it depends on the general market conditions that you're faced with. So, I think with the SA20 cricket going on, it's nice to make a cricket analogy. But if you're playing on a very easy, flat pitch and you're putting a batting team to go and play a T20, you can put in a couple of good batsmen and pretty much all of them will do fine. And that was probably the period from 2010 to pre-COVID. Interest rates were low. It was fairly easy to do well, even if you had an average batting lineup or share portfolio. We think that the next couple of years are taking this team to a very difficult subcontinent or Indian pitch where there's foot marks in the pitch and you're not sure what it's going to do. You really have to have the best batting lineup that you can think of, and a number of different batsmen that depending on what the conditions are on the day, they can perform. So that's how we're thinking about the portfolio at the moment, is just constructing a number of different ideas in the portfolio that, depending on the conditions that the year throws at us, should still be able to do well. I think that encompasses how we think about it versus the last 10 years.
Another thing is we don't sit and target an equity content level. We target opportunities. So at the end of the day, the equity content number is kind of a fallout number. It sort of tells everybody exactly, or it adds up what our good opportunities are at any point in time. And if it's at the mid-50s, well, that means we're a little bit cautious and we're not seeing the number of opportunities that we do. And that obviously changes and flexes as these opportunities come and go. So we don't sit and say we need to be at 50 or 60 or 70. It's actually a bottom-up approach where opportunities we find, we put in the portfolio, and funny enough, the equity content is really just the fallout number. We obviously monitor and do a sanity check as to where we want to be. Do we want to be at that sort of equity content? Doesn't make sense, but it really is a bottom-up number, that equity content number.
Look, I think to Matt's cricket analogy, I'm going to add one more thing there, is to say we still do keep our eyes open for when you find a really great standout idea. So like last year, for example, Tungela, that we've written about, and I'm sure many of you know the story, we could just see that this was there was priced so incorrectly, it was on a different playing field how cheap the share was. So in that case, you send that in right at the top. That's your number one batsman. I think for a fair chunk of the year, it was probably double our next position in terms of going size there. So you can trust assured that the one thing we've always done is when we've got a high conviction in the share and we're sure about ourselves, we'll hit that hard and we'll go big then. And there was lots of debates in office into just how big we could go, given how much Tungela had run. But when you feel you've got an edge and you're closer to a company and an opportunity, you can rest assured that we'll still press it very hard. And again, we don't know at the start of the year which those are going to be for the year. We'll keep our eyes open. We couldn't have called Tungela at the start of last year that it would be such a unique story, but we're ready to go big when the right idea is around.
Any other questions? No?
Everybody looks thirsty.
Everyone looks 100%. Everyone's just like, listen, give me an hors d'oeuvre. Okay, so I mean, just maybe to finish off there, Dave, I think as the founder and the person that's had to put up with all of us for the longest, you've earned the final word here. But I mean, it sounds like the environment is tricky. We're not obviously looking to add lots of beats to the portfolio because maybe market tailwinds aren't there yet, but you guys still sound pretty upbeat about opportunities. So, I mean, is that a fair reflection of taking the read in the room?
Yeah, I mean, I think we're very pleased with the start we've had. Obviously, markets have been strong, but we've captured, a good portion of that, probably more than we would have expected. So we've had a good start to the year. And again, forward-looking is always difficult. We don't have a crystal ball. We can't tell you where the returns are going to come from. But I think we're in a good space. We're vigilant. We've got a well-constructed portfolio. And I think what's exciting is we have got equity content room and we have got cash available that should those opportunities, or not should they, when they present themselves, I think we're going to be all over them and do what we do best. But I think the team is motivated. I think we're on the front foot. I think we're getting most of the return with a very low equity content at the moment. We have cash available, and I think we're ready to hit maybe not as many as we got last year as far as the list of disasters and one-offs, but sure as night follows day, there's going to be 3 or 4 of those coming up that as we sit here, nobody's really going to be able to predict. And when we do hit them, we're going to be ready to move quickly and to move decisively, and where we have high conviction is to take high conviction positions.
Awesome, cool. I think we can close off there. I hope you'll all join us for some drinks outside and some dinner. The guys will be around, so please, if you wanted to ask a question but felt slightly intimidated, grab them, quiz them. That's what they're there for. And I hope that the key message you take out of this is that while we're not bullish markets, I think we're bullish the opportunities that exist in our space. And I think as a hedge fund, this is kind of the environment where we hopefully thrive. We have that toolkit, we have the ability to generate that alpha even if the beta isn't there. And I think we're very well positioned to execute on those opportunities and hopefully make very happy investors out of everyone in the room. So thanks you very much for joining us, and enjoy the rest of the evening.